Good afternoon, everybody. Hi, friends. Let's just give it 1 second to see if we get stragglers. We had quite a few on the registration. So we'll give it 1 minute. I'll look at my clock and we'll go 12:01 and then I'll get started. Everybody can hear me. We are recording. Not as dumb as she looks, folks. Okay. I'd like to see some of our people, some of our regulars. Miss Annette. Hi, Annette. Okay. So while we're just kind of waiting to see what our attendance looks like, I don't know if anybody else has noticed, but I was told by my team that Microsoft has been intermittently in and out all day. So somebody say a prayer to the technology gods that we get through this and we stay on together, et cetera. We're looking at, just on a go forward FYI, we're looking at, we're probably going to switch to Zoom. I had gotten away from Zoom for other reasons, maybe about a year ago, but I'm being told that Zoom has really picked up their game in ways that would be useful to me. So I think we'll switch to Zoom. So you guys will see that soon. Okay, we got 12:01. Let's do this, people. I'm going to share my screen. You guys feel free to turn your cameras on if you want to be seen. You don't have to. I know it's kind of weird, but I like to see who's out there. Okay, let's share this. Let's see. Okay. So we've got this slide deck going on. I am so excited about this one. And by the way, this is going to be kind of a twofer, a two-parter. So today is house hacking specifically. We'll get into that. And then I think in 2 weeks from now, Michael, the 12th, Wednesday, the 12th of November.
Yep.
How in the hell did we get almost all the way through 2025? I have no idea. I cannot believe I'm saying that.
Yeah.
But the twofer is going to be on the 12th of November. We're going to have another one at noon. We do these on Wednesdays at noon as kind of the time that we've chosen. And we're going to really take more time. I've got a guest speaker coming in, and we're going to be talking about pad split. For anybody that doesn't know what that is, I'm going to touch on it in one of the next slides, that we won't focus on that today. But pad split, if that's a new concept to you, this is where you're taking single family residences, 3, 4, 5 plus 6 bedroom homes, and doing individual leases, per room leases with common areas, et cetera. So I'm seeing some really great numbers and returns. Obviously, you guys being the lender that's kind of up here that focuses so much on investor needs, we have access to, and I see coming across my desk every day, the appraisals, the incomes, the leases. I'm really liking what I'm seeing on this pad split thing. And I think that there's going to be a lot more opportunities in that space. Not to take a turn here, but AI isn't going anywhere, and I think that loss of revenue for some people, they're going to have to start finding other ways to. The co-living thing is, I think, going to be picking up some speed here. So for us investors, start paying attention to that. If you haven't already, it's going to be a part of your portfolio. I can almost guarantee it. Okay, here we go. I've got my slides over here. Hold on, you guys. Okay, just a click. So today we're talking about house hacking. What is house hacking? Most of you here, I am going to assume, are going to know what that means. However, we'll take the time to just quickly review and define it for you. So this is where you, as your primary residence, you are purchasing a property that can also be used for rental purposes. Okay, so whether maybe you do it as a pad split. I doubt that's probably less likely, but more often than not, you're looking at a 2 to 4 unit property. Maybe it's a single family with an ADU. Whatever the circumstances are, there are additional units where you're going to live in one of them, and the others are going to produce income in the form of rents, right? You're going to have tenants. Michael, can you mute? I don't know if we have control mute everybody. I don't know if you can. And if you can't, then everybody listening, mute yourselves, please.
I snuck away.
Thank you. Okay, so you get to live there. You've got income coming in that's going to offset your primary housing expense sometimes, right? If you do it right. I've got situations regularly, this is not uncommon, regularly where the individual that's done this in the right market and maybe the stars are aligned, et cetera, they don't pay anything for their primary housing. They're living rent-free technically. Somebody else is making that mortgage payment and they don't have a primary housing expense. Okay. And it's a really great way. You guys have heard me talk about the all-in-one probably a lot. It's one of my favorite loan products. But as a concept, house hacking is probably right up there, man. I really, really love this. And we'll talk about who it's for in a second. And it's not just maybe for who you think. I think a lot of people just dismiss this as an opportunity when they should be looking at it more closely. So that's house hacking. And feel free, guys. I don't think I said this. Put your questions in the chat, please. I think Michael's going to moderate for me, and as he sees them, he's welcome to interrupt. This is, as always, a very fluid conversation. Try not to be too rigid with the back and forth commentary. Okay, like I said, who is this right for? So you may be surprised to learn it's not just for a first-time home buyer that wants to get into, an FHA loan with just a little bit down, right? I love that as a model, but let's just kind of take a minute and go through the bullets here. It can be first-time home buyer, of course. And if you're going to do that, you might as well, if you're okay with living in kind of a commune where you've got other units attached to your home, you might as well get a duplex, triplex, fourplex as a first-time home buyer. And first-time home buyer, by the way, is not necessarily what it used to mean. The programs aren't just for first-time home buyers. You can get FHA loans at 3.5% down. Whether you've had 10 homes before or not, it doesn't matter. So that's kind of a misnomer. But if you are a first-time home buyer, absolutely consider purchasing a 2 to 4 unit so that you've got renters in there making your mortgage payment for you. The next here would be investors expanding with minimal cash. So let's say that you have your primary residence right now. It's a single family residence and you're thinking, I really want to get into real estate. But I don't have 20, 25% down. I don't have that kind of capital right now. Okay, well, turn your primary residence into a rental or sell it, whatever. If you have 3.5% down, that's the lowest amount down that you're going to find. Actually, I think 3% down. There's a flex, a Fannie Flex. Anyway, but 3% down, you guys, 3.5% down. If you can swing that, then chances are you can get into a new primary residence, keep or sell the departure residence, right? Keep it as a rental or sell it. Move in to one of the units, FHA, rent the others, boom. Okay. So investors expanding. Anyone tired of paying rent, right? If you're just stuck paying the landlord every month, $2,000, $3,000, depending on where you live, and you have no ownership, no appreciation, no depreciation, you want to start building a portfolio, absolutely. And do the math. I think you'll be surprised. Anybody that's on right now or hears this later, I think that for those that are renting as their primary housing expense, they just think that it's out of reach. Home ownership might be out of reach because of the headlines. I think that as a society, I know I'm guilty of this too, we maybe read the headlines. Michael, can you grab that? I don't know if you can. Yep. Thanks. You read the headlines and you just make those assumptions. Okay. If you're spending X on rent, you may be surprised that, and interest rates have come down, we'll get into that, that a principal and interest payment, especially when you have other units there helping you make the payment, you've got other units of rental income helping you make the payment, is probably less than you're spending on rent right now. I would guess, I'd say at least 50% of those people should be earning equity and what the other benefits of real estate ownership is, instead of just throwing their money away on rent. Okay, and people seeking financial flexibility or early retirement options. This is a good one too. Let's say that you're just at the precipice of looking at early retirement. You're done. You can't do it anymore, and to do that would mean if you're going to quit your 9 to 5, you've got still have all your expenses. This might be good for a 55-year-old, 60-year-old, 50-year-old, 45-year-old that's just done, that doesn't have a lot of expenses. They have their primary housing expense, and it's not going to afford them an opportunity to reduce or remove that 9 to 5. This might be a way to do that. So really, it's for anybody that wants to build in real estate.
I had a question.
Yeah.
So you mentioned the majority of house hackers start with kind of the least money down option at 3.5% for FHA loan. But what about service members?
Thank you, Michael. So VA, He's talking about VA loans. These are probably some of the best 30-year fixed mortgages on the planet. Well, first of all, you're not going to find 30-year fixed mortgages in most of the rest of the world. It's unique to the United States and maybe a few other places. But the really great thing for those that have access to this, the eligibility for VA loans, 0 down, no PMI, and much lower rates than the other loan products. I love that. Yeah, you can house hack on that too. Absolutely. So just to quantify, you guys, when we talk about kind of, you hear the buzzwords agency, conventional, conforming. It's important to differentiate. You got Fannie Freddie. Okay, that's basically agency. Then you've got FHA, you've got VA, and you've got USDA. FHA, VA, USDA, those are called Govy loans. Slightly different. They will only ever apply to owner occupied. Now, an owner occupied can be a fourplex as long as you're living in one of the units. And the reason I just give you this distinction is because people confuse that a lot. If for just regular investment property acquisitions or refinances, you'll never use a Govy loan for those. That's not what we're talking about today, just to clarify. Fannie Freddie are the only conventional loans that would apply exclusively to a non-owner occupied transaction. Anyway, yeah, thank you, Michael.
I had another question on that. You mentioned the Govy loans are only for owner-occupied properties, but let's say you buy a house, you live in it for a year or two. Mm-hmm. Can I keep that loan in place and move out of the property, turning it into a full-time investment property?
100%. So what he's talking about, and this is part of, we have clients that do it this way. So when you sign your loan documents, we're taking a little bit of a U-turn here. When you guys go to the closing table, you're in front of your notary, you're signing your loan documents. There will be language in there that stipulates that you intend to occupy or use the residence for that purpose for 12 months, whether it be a rental property or a primary residence. Let's focus on primary residence. So you're signing those loan documents. Your intent is to live there for 12 months as your primary residence per the legal document that you're signing. What you do after that is entirely up to you. So to Michael's point, you can take that and now that becomes a rental. You can be really strategic about this. Now, we're not going to get that granular today, but there are people out there that every year they find a property, they move into it. Let's say it's a duplex, whatever. They move into it, they live there for a year, they make that a rental, and they're moving into the next duplex a year later, and so on and so forth, right? And in 3, 4, 5 years, they could have 10, 20, 30 doors. Right? That is absolutely feasible. Now, I will tell you that if you're using FHA, this might be an important nugget or detail. FHA comes specific with a case number. Okay, you can only have one FHA loan at a time. So if you did this and you started with an FHA loan here and you wanted in a year later to purchase another property and use FHA, no can do. You'd either have to refinance this into a conventional mortgage, and maybe, who knows, maybe there's enough juice in it, there's enough appreciation, whatever, that would justify that. Maybe you pull cash out, maybe take longer than a year. It depends on the market, of course. But if you're wanting to use FHA each time, you're going to have to refinance the departure residence into a Fannie Freddie so that the FHA case number is released and you can do it again. Otherwise, maybe you start FHA and a year later you go conventional Fannie Freddie at 5% down. Okay. Okay. Let's just quickly go through core benefits. There's a really cool calculator here, you guys, that I want to get to. Michael and team took some time. I love it. You guys are going to have access to it. I'm excited to show it to you. So core benefits, obvious stuff here, I think. Let me just look at my notes, make sure I'm saying everything I want to. Okay, well, let's just read through them. So investing jumpstart. So I said earlier, if you don't have the 20% down necessarily, right, and you really want to get into real estate investing, this is a perfect opportunity to do that. 5 to 3.5% down is available to you. Live for free, right? If you do this right, your housing expense it will be mitigated no matter what. But there are circumstances where I see people don't have a housing expense. And we'll play with some of the numbers in the calculator, and you can you'll be able to do it for yourself and see if you are one of those lucky people that are in the right market, that have found the right property where the rents will completely cover the PITI, principal, interest, taxes, and insurance. Future leverage. Obviously, appreciation is a huge part of real estate as an asset class. It's one of probably the drivers that people want to get into real estate, is because you have that appreciation. So future leveraging, remember, if you were to harvest equity, borrowed funds are non-taxable. So if you buy a property today, in 5 years from now, let's say you've got $100,000 of equity, you can borrow against that, whether a cash out refinance, if you can find a second lien HELOC, et cetera, et cetera. Borrowed funds are non-taxable. What are you going to do with that non-taxable capital now? Are you going to use it to probably invest in more real estate, right? So future leverage, cash flow growth, build positive cash flow over time. So, everybody's got a different idea and again, very market specific here. But if you are not appreciating your rents by a minimum 2% a year, I think 2 to 3% is kind of that minimum. I would have a conversation with the property manager. You may be the exception to that rule that increases in rents are just not appropriate for whatever the reasons are. But the vast majority of us should be increasing those rents by at least 2 and 3% annually. And then financial stability. Okay, improve financial stability by lowering your cost of living. What does that mean to you? If you're able to shave off $1,000 or $2,000 off of your monthly housing expense, what can you do with that money? Right, and that's going to be individual. I can think of 1,000 things that don't just simply include shoes, new shoes, but right, that'll be individual to you. So lots and lots of benefits here for the house hacking. All right, let's move on. Okay, here we go. This is our calculator. So I think, I just can click this, right,
Stanley.
Michael? Hi, Stanley.
Hold on one. Hi, Stanley. One sec. Let me see if I can find that.
Thank you. Okay.
Yeah, they got it.
So let's go first and foremost. Okay, we did try. There was a concerted effort to try and make sure that when you guys play around in here, when you go do this for yourselves, that we had the county loan limits that are appropriate, differences between FHA and Fannie Freddie. It's quite an undertaking at some point. I know we're going to get there. So please, the disclaimer here is do your own due diligence. I actually think that there is a slide. I'm pretty sure probably Chris got this for us on the next one. If you guys want to take a picture of the next slide when we get there, you'll have the links to the FHA county loan limit calculator online and Fannie Freddie's. That way you can plug in the county or the zip code, whatever, and it'll tell you what the county loan limits are, because that is important, right? If you're in an area where you think that you can get a $600,000 mortgage, right? But the county loan limit for FHA is $575, that's a problem. So do some of your own due diligence. That's my disclaimer. So here we go. So 3 easy tabs here, property, income, and then we'll look at some of the metrics in the advanced number crunching. I'm using for us, you'll notice here on this bar, you've got just the 2 to 4 unit, right? Duplex, triplex, fourplex. I mean, I guess, no, you couldn't, could you? I was going to say you could probably do this on 5 unit and above, but you're going to have to, you could do this. If somebody's looking to buy a 5 or 10 unit place and they want to live there and manage it, et cetera, I think this might work, but you're not getting 5% down. Just know that you're going to have to adjust your down payments, et cetera. So for our purposes, I'm going to choose a fourplex for my example today, but there's your ADU. So single families that have ADUs attached, or you're building an ADU, you can get that one in there. And then there's your kind of room rental pad split thing for those that want to look at that as well. Okay, so let's go. I think I'm going to go FHA. All right, 500,000, 3.5% down. We've got 6.5% rate, 30-year fixed, right? A lot of this is plug and play. That's probably a little high on the interest right now, but that's okay. Let's be conservative. Taxes, 1.2%. This is all editable stuff, you guys. 1.2% is what I've chosen here on the purchase price, right? So the math is embedded. And then we're going to put, we'll put insurance, taxes and insurance on a fourplex. Let's say 1,800. Okay. You guys will put your own numbers in there. Next. Okay. So let's go. This is a fourplex. So we've got 3 rentable rooms, and I'm going to say that each one is rented at $1,000. Okay. And you'll see along the way, you've got vacancy. Did I miss one back here? I don't think I did. Did I?
No.
Hold on, you guys. No. Okay. So you can toggle this, right? Your vacancy rate. I'm going to throw this at 5. Let's hope it's less. Okay. Just know that when we look at the metrics and the numbers down below, that is part of the math here. So there's our gross rental income, $3,000. Okay. We've got our vacancy at 5%. So that dropped us $150. Okay. Now you'll notice here's some of the analysis. I'll get there in a second. But actually, hold on. Yeah, okay, I'll get there in a second. So property management fee, chances are you're not going to have a property manager on a 2 to 4 unit. I guess you could. I would say you probably want to do it yourself, even if you've never done it before. It'll be great learning experience, invaluable even for future stuff, things that you want your property manager to be aware of, and maybe niceties that you want to include for your tenants, and all these different things. So if you are thinking of purchasing a 2 to 4 unit or whatever, and you're going to have it professionally managed, one, is going to chew into your cash flow, and two, I think at least initially, get the experience, man. That said, let me give a word to the wise for that. If you are going to personally manage this or any rental property that you own, don't let the other tenants know that you're the owner of the property. I think for a variety of reasons that you guys can probably guess, I would keep that, separate, right? You are just another tenant there. Because if you have to be a heavy for any reason, it's just going to make it easier. And there's other things too, but that's just my advice. I learned that the hard way. Okay. Appreciation. So this is going to be individual to your market. Again, we're using 5%. I think this is probably average to low, depending on market. And then rent increase, I've got it at 3%. Feel free to change those if you guys want to. Okay, moment of truth, gang. So let's take a look at this. We've got a principal and interest payment. The math is, again, already built in here. Principal and interest payment using $500,000 at 3.5% down and 6.5%, right, on those preceding tabs. So that's our principal and interest payment. There's our monthly taxes. That's the tax amount we put in divided by 12. There's our insurance. And then mortgage insurance. Okay, mortgage insurance is going to be applicable for anything over 80% loan to value. So there we've got our PITI, okay, all in, $39.74. There's our rents. We've got our vacancy. Okay, so check this out. These are our returns. Now, you're going to show a negative, for example, on cash, but only because you're living there. You can go back, and I played with this last night. You can go back just so that you can see if you're going to move out in a year or 2 years, etc. Go ahead and change it to have the actual 4th unit rented. Okay, so you can see what the actual cash on cash would be. These look kind of funky because this is your primary residence. But let me ask you this. A fourplex, you're spending this monthly cash flow right here, this number right here, and feel free, you guys, all of these have your FYIs. It'll tell you what you're looking at. So this individual has an investment property, fourplex investment property, and their primary housing expense is $1,124 a month for their own home. Okay, I don't think anyone's going to argue that that is a good deal. Okay, now this is where I want to focus on some time, and then we can open up to some questions. So the math has also been done for you. It's taking a 5-year wealth projection. Reminder, look at your FYIs here. Go ahead and dig into those because each of them has the why behind the how. But we're taking our 5% appreciation. We have an amortization table in the background of this app, this calculator. That's obviously you've paid into after 5 years how much principal has been paid. It's not going to be a big number, but it's something. And then your cash flow, $107,000, almost $108,000 over a 5-year period of time. That's a good return for an owner-occupied property that you're living. That you're living in for a very, very cheap amount monthly. Now, also check this out. I think I started to allude to this earlier. Because you're doing this as a house hack, okay, because you put 3.5% down, your cash position maintained versus if you were just buying an investment property, that's $82,000. That's the difference between the 3.5 and 20% down on a traditional investment property. That's a big number. This one I think is one of my favorite data points here. So the other, it's tied into what I just said about the cash position. But in a DTI way. So we have rental income, right? And I think this is where a lot of the questions are going to come in if I had to guess. So I've got 3 other units that have rental income. Now we're just talking about how it's going to benefit the individual from that cash flow perspective, that wealth building perspective, all of that stuff. But think about it from a lending perspective and what you're going to qualify for. So you have just increased your buying power by $160,000 because I have $3,000 of additional rent that I get to use to help offset a portion of. And I think Michael dialed this in. Let's take a look. Boom. So in here, you've got your 3,000 per underwriting guidelines. We're allowed to give you 75% of the gross rents of the other units. Okay. So 2,250 of the 300,000, we have increased your spending, your price point by $160,000. That's amazing, right? That you wouldn't be able to qualify for otherwise. You've got that extra on an owner occupied deal. You've got that extra income helping you cross the threshold of the DTI restrictions. Fine. Okay, I zipped through that. What questions? Do we have questions in there anywhere, Michael?
We just have one question so far, which is, this is a market specific question, which is, is Seattle a good market for house hacking? So maybe it'd be a good idea for us to kind of go into, which markets tend to work for this kind of investment strategy.
Honestly, you guys, I think every market is going to work, but neighborhood by neighborhood. See, market is such a general term. And when you say market, it's individual to the city, to the state? I mean, let's define it a little bit better. Even per city, I think there's going to be areas that this is going to work. Even if you have to go maybe outside a growth boundary, maybe the rents aren't strong enough right here. You just go a few miles down the road. I think that this works everywhere.
Yeah.
What you need to do is you got to figure out, I mean, it should be very easy for you to do your dear Google searches and figure out what median rents are in certain zip codes. Okay. And then depending on the property that you're purchasing, let's say that you can find new construction. Okay. And let's say that the median rents are $1,200 for an apartment, whatever. Okay. If you have a new construction fourplex, you're probably going to be able to garner or gain more income than, say, the traditional apartment. So when you're doing this work, and feel free to tap us, okay? I'm happy to give my 1.3 cents worth, second set of eyeballs if you're engaged in this and really want to do it for yourself. Let's go through it together. It's not going to hurt to have somebody else's point of view in there with you and maybe ask questions or think of things that didn't occur to you to look for. The answer to the question, I think all markets this is going to work in. You have to do the math. And I feel like a broken record because I say that so often, but it is so true to the core of what all of this is about. If you're not doing the math, I want to know why. You need to tell me why, right? Is it just psychology? You can't get over the idea of X. You have to be doing the math in every situation and every nuance that you can think of. Just do the math. And then there's certain things that are going to be out of your control, I understand. But if you're doing the math, you've got a good team around you, you should be pretty well insulated from making any decisions that are hard to overcome.
Speaking of math, I mean, that is one of the reasons why we're investing so much time and energy to build tools like this that are free for our customers, because we really want to equip you with the information that you need to make informed decisions when it comes to building a portfolio. Now, I had a question about this cash position maintained. It's just maybe a scenario you can answer for me, Shaylee, which is, if let's say I'm gearing up to make an investment purchase and I had the money to make a 20% down payment, and I found a duplex, triplex, or fourplex, and it was a bit abused, it was neglected. Okay. Would it make strategic sense and maybe require a little bit more creativity for me to consider purchasing that property and leveraging the cash that I saved to renovate?
Hell yes. Yeah.
What would happen to my rents as a result of that renovation?
Well, they're going to go up by X, right? I mean, for sure. But the other thing to consider too is that if you can get lucky enough to find a property, let's say you find it off market, however you find it, it's undervalued to start with, and it needs 50 grand in renovation. But by doing that, if it's in the right area, right neighborhood, et cetera, you probably appreciate the property on its own by X. You could probably end up doing a cash out refinance, potentially, and pull some of that cash back out. But yeah, your rents are going to improve as well. I don't know the exact, if anybody knows this on the call, if there's a formula, just like a generic formula that's used. I don't think that there is. I'm trying to, if there's a generic formula used that says that if you upgrade by X, maybe there is. If you're renovating and improving by a factor of X, what does that mean for the actual rents? I don't know if there's a percentage that we can use as a marker, but absolutely you should be able to garner more rents as a result of that. And obviously the ARV after repair value should be improved. I probably would make sure that that's the case before you go down that path. Don't do it if you're not going to have the upside in both rent and ARV. But yeah, I love that. Absolutely. Yes, yes, yes.
What sort of, like, how would an investor validate that potential ARV?
That's going to be difficult because you guys have access to Zillow and Redfin, right? I mean, that's typically where we go. There was a time in history where the last place in the world I would go would be Zillow to try and baseline an ARV or a value, but Zillow has stepped up, and that's a decent place to go. The problem is that the algorithms there, they're not going to account for any of the rehab work, right? They don't have that information. They won't. So you can give us the address. We can run county records and see age of property, et cetera. There are other things like BPOs, broker price opinions. They're relatively inexpensive, 100, 200 bucks. We can order those for you if you wanted to get an idea of what that would look like after X. You know, you're going to have the scope of work, not just a dollar amount probably. You'll have to have the scope of work of what you're going to be putting into it. And then we can help provide some feedback. If you wanted to, you could certainly find an appraiser in the area. Just Google local area appraiser. They may be able to do it for you directly, BPOs, so that you can get a feel for what that ARV is going to be. Because at the end of the day, I'm not saying don't trust the agents. I'm sure the agents know, but the appraisal is the end all be all to that the answer to that question. And by definition, you guys, an appraisal is an opinion of value. Okay. As much as it pains me to say that, that's just the truth of the matter. So make sure that if you're going to get into something like that, where you want to add value and you're going to put your own money, maybe even some sweat equity into it, and build up the ARV, and you're expecting a certain number, make sure you're close, right? Get as much data as you can. Go to Zillow, go to Redfin, get a BPO, check with the agents. The more data, the better, so that you have a good idea of what that ARV is going to be. You're not surprised when it's $50,000 less. That's a problem, right? The market might dictate. There's all kinds of variables in there that could jack you up if you're not prepared for it. So, and if you were expecting to get that money back, especially, you want to be careful to really take some time on the ARV analysis. What else we got, guys? I think we're ahead of schedule. Look at that. What should we talk about? Here's a couple tips here. Look at how smart the guys are. So mortgage insurance, anything over 80%, I think I mentioned this, anything over 80%, you're going to have mortgage insurance. FHA is a standard 0.55%. Take the loan amount times 0.55, divide by 12. That's your monthly mortgage insurance. Fannie Freddie will also have mortgage insurance, but it isn't just a flat fee. It's based largely on credit score and debt to income ratio. It can be as low as 0.23, maybe even lower. Same formula. Take the factor times the loan amount and divide by 12 months. So 100,000 times 0.3, divide by 12, and that's your monthly PMI. Credit score largely determined on the Fannie Freddie mortgage insurance. Check zoning laws, HOA rules, renting rooms, right? This is important. ADUs. You've done all of your homework. You can't just build, right? There's got to be permits, et cetera, et cetera. But do check for the per room renting rooms, right? Similar to the short-term rentals. Check the municipalities, see what the laws are. Find out if you can. I mean, go to your local chamber of commerce and find out if there's anything on the books for changes to things like short-term rental or pad split, et cetera. And if there are, let's say that they're in the lineup to be reviewed, will the people that are doing it be grandfathered? Right? Those are questions that you want to have answers to before you get too far down a rabbit hole. Can you deduct expenses? Absolutely. You can deduct expenses for rental portion of your property. It's going to fall on your Schedule E, just like any other rental property would. You've got the depreciation. On a 2 to 4 unit, yeah, I think they'll just subdivide the values and give you the full 27.5% depreciation, and then all the other stuff that comes with the expenses, right? All the stuff, that portion of the taxes, the interest, et cetera, et cetera. Any other questions we have? Feel free to. I want you guys to check this out. Oh, actually, let me go through my my slides. I'm still in my slides, aren't I? Why am I not moving in my slides?
I think it's the tab next to the calculator in your browser.
What?
At the top of your browser, just click on the tab that's house hacking, how to live. It's at the top left.
Oh, I'm on the calculator. Sorry.
Yeah.
Thanks, Michael. Good thing he's here. Okay, here's those for the county loan limits, you guys. Anybody that's interested in this, take a
Can you put those in the chat, please?
Thank you, Chris. This will tell you what your loan limits are. And a change, you'll notice, excellent work. Chris, thank you for whoever did this. Whoops, no, I want to go back. Here's just a county. We used one in Oregon, Clackamas County. You'll notice that it changes. Single family, 2 to 4, or 2 unit, 3 unit, right? It gets higher, right? The more units you have, the loan limits get higher. So that's a benefit. Okay. How to qualify. Let's take a minute and round this out to qualify. And then if you guys have any questions for me, we'll be here. You may use, like I said before, you may use the projected rental income of the other units to help you qualify. If you're going to do the pad split, single family residence, you will not be allowed per guideline to use room leases. So you'll have to qualify on your own for the full PITI. Down payment, as we've talked about, FHA allows 3.5% down, Fannie Freddie 5% down. Minimum credit score typically is 620. Just know that, on that lower end of the spectrum for credit score, you're going to be paying a higher interest rate. Okay, it'll affect the rate. And then you must occupy one of the units for at least that 12 months. We touched on that as well. The documents that you sign stipulate you intend to occupy for the following 12 months. Now, I will just say one thing about that. Life happens, shit happens. If, it's not as if someone's going to show up and put you in handcuffs and take you down to the clink. The intent is the most important. If your job relocated you, right? That kind of thing can happen. Just know if you're going to try and manipulate the system, and people do this, you're probably going to get caught. Right? We don't do stuff like that here, just saying it out loud. But I want to make the distinction between intent, right? And things happen, it happens. And then the individuals that are trying, every couple of months to redo this, it'll catch up to you. And it's not worth it. Trust me. And I'm going to read this out loud because I love it. Bottom line, live smart, qualify strategically, and turn your first home or your next home into an investment property. Okay, I think we kind of went through this. Mortgage insurance. Okay, this might be real quick. So there's our down payment, credit score, mortgage insurance, rental income use, best for. Okay, FHA, a little bit less down. FHA credit score requirements have a little bit more flexibility. I don't even know if we go that low. If we go that low, I think you can find them that low. 620 is for conventional, 5 to 20% down. Now, this is interesting. This is what made me want to stop here. FHA, so mortgage insurance is kind of go to lunch free money for the investors that pick up these loans, because what happens is, in this case, is no matter what your LTV is, loan to value, because remember, the PMI doesn't kick in. You don't pay PMI as a borrower on a loan until over 80%, 80.01 and above, you're going to pay PMI on any kind of conforming conventional loan. The rule, though, is that it drops off, and I think this is actually 78% now, Michael, FYI. I don't think it's 80. I think it's 78% by some combination of reduction of principal, right? You've paid your mortgage payment, you've reduced the principal, and appreciation, right? Some combo of that. Conventionally, you can get that removed once you hit, again, I think it's 78%, maybe it's 80, double check me. But FHA, never. You could be at a 60% LTV and you're going to be paying mortgage insurance. So that kind of sucks. But hey, you got 3.5% down payment and the interest rates are among the lowest. So they're going to make it somewhere. Rental income use, maybe a little bit more flexible here. Not so much. I wouldn't focus too much on that. And then lower credit scores, as you can see there, stronger credit scaling. Okay. Comments, questions, you guys. And then I don't want to forget, I'm just going to zip past this one because I don't care. We are going to, please, if anybody wants to go through a scenario, whatever, please email info@ridgelandgroup.com. You can fill out on our website an intake form to be contacted. We'll get you that way, and we'll get you on the books. But we are going to be sending you guys both the calculator in the coming days. I don't know exactly when, maybe this week, early next week. Michael can answer that. And an ebook. So we put together this ebook. I want to take credit, but that just would be wrong. Michael put together this really cool ebook. I helped. I supervised. Can I say that? Do I get credit if I supervised?
You pay the bills.
Okay. So, but he did such a good job, and it's not some bullshit stuff. There's really tangible, good stuff in there that I think that you can use about house hacking. I should have, I should have grabbed a page because I remember it's got stuff in there like as a first-time home buyer, what do you do next, right? Call your utility company, and just some really good, solid information that I think you guys can use. You're going to all get a copy of that, use it, burn it, whatever, give it to your kids. Oh, I don't think I mentioned this. Let me just make a quick comment. So for those of us that have, college grads or soon to be college grads, FHA, that down payment, non-occupant co-borrowers, right? Obviously, our kids are not going to be able to qualify on their own, probably, exceptions to every rule. But this might be a really cool freaking way to kind of get them launched and on their own 2 feet, where you can get a fourplex. Maybe they go get their roommates, whatever. They've got their units. You can co-sign with them if you need to. You've got the rental income to help offset. They may not even need the co-signer, depending on what their job situation is and the seasoning of that job. Because if they got a job in the same field that they just maybe graduated from college from, we can give them that income immediately. That along with 75% of the rents. Maybe they can do it on their own. Maybe they just need a little bit of help in the down payment, the 3.5% down. So that would be another thing for those of us that want to support our kids that way and get them into home ownership and get them on that path for seeing what real estate investing can really do for them, right? That would be another really big one. I probably should have put that. I'll put that in one of those slides for the next time I want to spend more time on that. Stay connected. Join us for the next webinar on November 12th. As I said, this is going to be about pad split. Mr. Sean O'Connor, I think it's O'Connor. He's going to be joining us. He's been doing this as a philosophy for his real estate investing for the last, I think he told me 7 years. So he's got a real strong hold on markets, what to be looking for, what not to be looking for. Like I said at the top of the hour, you guys, I really like this pad split strategy. I think it's gonna continue to pick up speed. That, and I think December, we're probably going to do something about tiny homes. I'm putting a lot of time and education and information into tiny homes for the other reasons that I was talking about. We're going to need more affordability in the housing sector of this country. And I don't know if you guys have spent any time Googling tiny homes. Have you seen these models? They're beautiful. They're absolutely gorgeous. And Ridge is coming up with specific lending for this and investors where, maybe even as big as build to rent, right? So you've got 10 of these things on a lot somewhere, maybe 50, maybe 100, and we create communities. I'm putting some time into that. So we'll have some more information on tiny homes and how that can support us investors and the economy and our tenants and renters. So that's on the horizon. Any other final thoughts or questions for me? This one seemed pretty easy.
Christina just also mentioned that we're also going to be rolling out same sort of access to capital for barndominiums.
Oh, okay. Do you, Christina said that. Do you want to comment on it, Christina? What do you know?
Or maybe I misunderstood her.
No, I was agreeing with the tiny home concept. And I love the barndominium concept.
Well, now, Christina, now you got to find a source for us.
Yeah.
Yeah. Actually, you know what? So hold on, Christina, I think we had a client that did this. They were sisters, if I remember correctly, and Fannie will do them. The barn, yeah, they'll do them now. There's some caveats,
Sweet.
but they'll do them now. Describe what those are, Christina.
Essentially, it's a large barn. It's all one level usually, and they just turn it into a living space /
open
storage for whatever the heck you need. But man, my brain goes straight to tiny Highland cows.
They're so cute, aren't they?
They are.
Tiny Highland cows. That's funny. Okay, guys, come on. What do you got? Anybody have questions? We got time. We got time on our hands. Anybody? Anything?
Yeah, we don't have to talk just about
this or anything. Yeah. Going once.
So if it's long to type, you can unmute yourself.
Yeah, please. Yes, Mr. Blankenship.
Yeah, I have a question.
I'll come back to you, James, in a second. Yes, Annette, please.
You mentioned VA loans. Do you do them?
Yes. So
Okay.
yes, thank you for asking. So just for those that aren't aware, Ridge Lending is a direct lender. So what that means is that while we reserve the ability to broker loans if we think it's to someone's advantage, not usually the case, we underwrite in-house. We fund these loans on our warehouse lines, but we don't service these loans. So we're going to take mortgage-backed securities, the loans that we close, and bundle them up, and we're going to resell them on the secondary market to what we call aggregators. The reason that I go into all of that detail is just to share that gives us the access to a very diverse menu of loan programs that include Fannie, Freddie, FHA, VA, USDA, DSCR, bank statement loans, asset depletion loans, first lien HELOCs, what am I forgetting? Ground up construction, commercial loans. There's very, very little that we cannot do in way of securing leverage for you. The only thing that's not on the books is bare land. I do not have any raw land access to funding. Otherwise, definitely ask. No ask them, no get them. Chances are we can at least quote it for you. Mr. Blankenship, I owe you a call. I think you've been on my schedule and we've been trying to talk. So I'm glad I'm seeing your name. I'll try to get to you. Oh, well, we'll figure it out offline. What was your question? Build to rent, right? Is that what I saw? Yes, build to rent.
Yeah, build to rent.
Well, is there more specific there that you want to ask? Or yes, build to rent. Will build to rent work? Yes, absolutely. In this house hack? Sure.
I had a question also kind of related to that, but may not be something that we want to go into too much detail, but I had a friend who was a real estate investor and he purchased a fourplex using a FHA loan, but it was a 203K.
So this is a rehab loan. So, and I wish Pauline was here because she knows those like the back of her hand. We do these, and what he's talking about, it's the K, right? Or is it the B? No, It's the K.
No, the K.
It's the K. So there's 203B and 203K. The K is the one that will allow you to include rehab or renovation in the purchase up to certain limits. And if you know those, Michael, feel free to say, because I'm not well versed, but yeah, if you find someone that needs that work and you don't have the capital, you can finance it via an FHA loan. Sure.
Yeah. So the way that I understand it is you can purchase a home for the purchase price and finance. Essentially, what you're doing is financing 96.5% of the after improved value of the property.
Okay.
And there's a draw, like you've got your initial takeout, which is going to be, let's say, X, and then you've got your after improved value that is established by submitting plans and getting kind of a BPO in place. And then there's a draw schedule that your contractors essentially are going to work with your lender on. And you can essentially finance those repairs and finance 96.5% of the renovation.
Is there a max on the renovation, Michael? Like 50,000, 100,000?
I don't think so. I think as long as you're within, but I don't know for sure. Yeah.
Okay.
We'll have to look into that.
If that's of interest to anyone, tap us. We'll get answers quickly. What else? I think I saw a few questions coming in.
Yeah, we did have a question here that was from Casey. She asked, they said that they're recently furloughed. How does that affect them when applying for financing?
I'm sorry, Casey. Our political system, whatever your predilection is broken, right? I mean, what a shit show. I'm so sorry. Yeah, we will not be able to fund anything for you until you are gainfully back in play. I'm sorry. Yeah, we've had a few of those instances, unfortunately, come up where they were federal workers, government workers, and we had to pause funding at the closing table because it had just happened. It's when, anyway, yeah. So I apologize. Keep us posted. If you want to talk offline and have a conversation about getting ready in advance, hoping that this doesn't drag on too much longer, we can certainly do that and just be ready to rock once it's over.
Some other questions here. Where can I find out details about qualifying as a first-time home buyer in the FHA program?
The easiest way to answer that, who asked the question?
Oh, we have so many questions now. Here's the Luke.
Oh, Luke. I would say, Luke, let's get on a call, man. Let's get on a Teams call. Let's get on a phone call. We'll go through a quick Q&A. Probably won't take longer than 5 minutes, and I'll tell you what your at least back of the napkin qualifications are. That's probably the easiest. There's a lot of variables to go through, but it boils down to credit, assets, and debt to income ratio typically, right? There's lots of nuance in there, but a 5-minute conversation would answer that specifically. And I really want to quickly go back, Casey. We may be okay. I don't know what your circumstances are, what you're trying to do, but just to make sure it's clear, you don't have to have income to buy an investment property, right? We have DSCR products that are exclusively going to look at the property's income divided by the mortgage payment, in which case you're good to go, right? Furloughed or not. So if it's for, we've been talking about owner occupied, so I didn't automatically jump to that.
Wayne asked the question. He just found out that there are new manufactured homes built as multifamily units. Have you heard of those, and do you fund them?
I'm sure we could. They're manufactured 2 to 4 units, huh?
Cool.
Wayne, yeah, email me. I'll give me the specs and I'll get you an answer. cridge@ridgelendinggroup.com. Actually, no, email info@ridgelendinggroup.com. That way you're sure to get an answer quickly and I won't miss it and it'll get on my desk and we'll get you an answer. Thank you, Christina.
Let's see here. Yeah. I think that's all the questions we have for today. I'm super excited, guys, about 2 weeks from now when we're going to actually talk about pad split. Some of the numbers we're seeing on the investment side are ridiculous. In many markets, it is one of the only sort of cash flowing model that works. So it's going to be a great webinar. The calculator resource that we built, we put it in the chat here. It's going to go to you via email along with Chaley's book. And, if there are any other tools, resources, or information that you would like to have at your fingertips, please let us know. We are pushing really hard to build out the resources to make you better investors and more well-equipped to make good, fast decisions.
Thank you, Michael. Yeah, good points on all that. I'm seeing more questions. Should we get these? I've got a few minutes.
Yep.
And the pad, well, we're looking at those. The pad split, you guys. It takes a little bit more brain power. Okay, there's extra nuance here. There's going to be extra risk, right? You've got 5 people in one home, shared areas, etc. But the return should be worth it. I mean, you guys know the rule: higher the risk, the higher the return. So there's definitely more to that. You have to know more. You have got to be more prepared. But I'm really keen on bringing as much of that to our database of investors as we can. So yeah, the 12th is going to be good.
Prince had a question here, said, based on your recent DSCR comment, income's not necessary. Does that also mean down payment is not required?
Good question, Prince. Unfortunately, no, you're still going to have to. So if you're on the DSCR side, right, you're going to be looking at 20% down. 20% down is going to be required. Yep, 20% down. No income, personal income, no personal debt to income ratio. It's a debt service coverage ratio where if the property's rents are the same or greater than the PITI, you got a loan, but it is a 20% down deal.
We had a question here. Do we also fund mixed use properties, like 86% residential, 14%
Sure.
commercial? Yeah.
Sure. Now, I will tell you, anybody that needs commercial type lending, we are currently not. There are exceptions to this rule, like anything else. We're not traditionally accepting applications for commercial through the rest of 2025. The reason for that, and this may be a good closing point, is this is the busiest time of year for us. Ridge Lending Group is focused on investors. Okay, the mortgage industry as a whole for the last 2 months of the year is on hiatus, right? We've got skeleton crews from appraisers and underwriters and processors because the mortgage industry is 99% owner occupied. There's very few of us that really apply or focus in this non-owner occupied space. Well, our investors are clamoring, they're coming out of the woodwork to get these year-end tax credits. So we get busier while the rest of the industry recoils. So turn times are delayed. Then you've got short months with holidays, et cetera. If anybody on this call is looking to do something between now and December 31st, you better, if you don't already have your application in and you're not moving, you better get moving real quick because the clock is ticking and it comes up fast. But to the point about commercial, so for that reason, commercial is a little bit more labor intensive. We're not taking new applications until after the first of the year. Mixed use, yes, we can do it. It would have to be a very special deal if we would get started on something before early 26.
I think that's it for now, guys. Just be on the lookout for an email to go tomorrow. This email will have both the ebook again and the calculator. Feel free to reply to that email with any questions, suggestions for tools, things you want to know about to further your investment career. And then we'll see you guys in 2 weeks.
Okay, guys, thanks for being here. See you soon. Bye, everybody.